Investors in search of sustainable income often turn to dividend strategies. Travis Miller is a senior equity analyst at Morningstar. Travis, how important is dividend investing today, especially to those in or near retirement?
Dividend investing is in a very interesting period right now. If you look at what we call the yield spread, the spread between 10-year treasury rates or any kind of interest rate right now, and the dividend yields, there's a very attractive opportunity. That said, valuations are stretched. But that yield spread, if you look at it historically, the 10-year treasury yield at 2.5% right now and the S&P 500 yield at 2.2%, that's a very attractive spread relative to history.
Looking at the dividend universe, what's the outlook for the rest of the year? Do we need to assume the stock market will go up?
Valuations are really stretched right now for dividend payers, and that could be legitimate. If you look at, again, this yield spread phenomenon where dividend yields trade at only a small discount to 10-year treasury rates right now, companies are able to invest money in very good projects and grow the dividends even while interest rates start to rise.
For those who want to include dividend strategies in their income portfolio, what's a typical allocation versus other types of investment?
We think that allocations have come down for income parts of the portfolio, mainly because of valuations. Valuations, again, are really stretched these days. So for investors who are looking for both income and capital appreciation, it might be necessary to reduce some of that income-oriented portfolio in terms of total allocation.
Let's wrap up now. Thinking about the quest for sustainable income, what's the key point for investors to keep in mind regarding dividend strategies?
Yeah, investors should really be looking at the payout ratio, we think, for management. It's very important for dividend payers to see both a solid payout ratio, but not overextended payout ratio. The payout ratio is going to be the amount of earnings that management teams can return to shareholders through the dividend. If the payout ratio is too high, then they might have to cut the dividend or reduce investment in other areas where there might be good opportunities. If the dividend payout is too low, shareholders might be giving up some of the income, and some of that cash might be going to management that could be wasted on low return projects.